Hello, and welcome to Mayor Brown's podcast series, Credibly Challenged. This podcast focuses on risk management issues for financial institutions of all sizes, particularly those in the banking sector. My name is Matt Bisanz, and I'm a partner in Mayor Brown's financial services regulatory and enforcement practice. Joining me today is Bill Isaac. Bill is really a legend of the banking bar. He was chairman of the FDIC during the savings and loan crisis in the 1980s. He founded his own consulting firm that he still is the chairman of. He has consulted on numerous bank boards and is a regular commentator on all issues bank regulatory. So we're really honored to have him here today to talk not only about his storied career, but also some of the current trends he's seeing, particularly with the recent crises at several regional banks in the United States. Bill, thanks for coming on.
I'm happy to be here, Matthew. Good to join you and your listeners.
So maybe we'll go back a ways back from the present day. That you've had almost every job in banking, but how did you get started?
Well, I'm a native of Ohio, and I never wanted to do anything but go back to my hometown of Bryan, Ohio, and work in the family business. And Vietnam sort of interfered with that plan, so I went to law school. And when I graduated from law school, I looked at law firms around the country. I never thought I wanted to be a lawyer, but I decided to give it a go. And I decided on Foley and Lardner, which was, I thought, a really good firm up in Milwaukee. And so I went up there and I wanted to be a labor lawyer. They told me they didn't need labor lawyers, but they really were desperate for banking lawyers. And I said, well, I don't know anything about banking. I don't want to know anything about banking. So anyway, it was either I had to go find a different job or stay there. So I stayed there, and they turned me into a banking lawyer, and I really started to enjoy it. And after 5 years there, I did a lot of work at First Wisconsin, which was the largest bank in the state. So I did a lot of work around there. I did some work in Chicago, and I did some community bank work around Wisconsin. After 5 years, I decided I might as well go to a bank because that's what I'm doing. And so I went with the largest bank in Kentucky. They didn't have a general counsel. It was called First Kentucky National Corporation, and I became vice president, general counsel, and corporate secretary. And one thing led to another. Next thing I know, I'm appointed to the FDIC board, and I'm chairman of the FDIC, and I'm in the banking and thrift crisis of the 1980s. And I've stayed in that world since then. And I can't think of anything else to do because I know a lot about it and I enjoy it. It's good work.
That's impressive. Yeah, I think you were the youngest ever to be appointed to the FDIC board.
Yeah, still am.
Yeah,
I was 34, so.
Wow, that must have been quite a fire drill to be thrown into. Not even a fire drill, that you were thrown into the fire with just the bank after bank failing throughout the 80s.
Yes, and in fact, my first day on the job, I had gone to a dinner with the board and management at First Kentucky the night before because I was leaving and going to the FDIC. And the executive secretary of the FDIC flew out to Louisville, stayed at a hotel overnight. I met him there in the morning. He swore me in the lobby of the Galt House Hotel as a member of the FDIC board. And we got in a cab and went to the airport and flew to Puerto Rico, where we handled the failure of met a team of people from the FDIC there. And I oversaw the failure because the other two board members weren't around. So I oversaw the failure of the second largest bank in Puerto Rico.
Wow.
That's my first day.
Yeah. So back then you had a lot of bank failures, but I think they tended to happen a little more slowly, that you had some time to prepare for at least a number of them. And some of these, just reading in the history book, some of these failures dragged on for weeks at a time until the regulators finally put the bank into receivership. Is that something you've seen change in recent years with the speed of crises?
I'm not sure it's changed that much. The speed of when it starts is very fast today because of all the internet connections that people are making and online banking and everything. We didn't have that technology back then, but the creation of the problem doesn't happen overnight. But it does happen pretty quickly. And I can tell you that the first thing that I was concerned about when I got to the FDIC was the savings bank industry. The FDIC was the insurer of the mutual savings bank industry, and it was primarily in the northeastern part of the United States. And they were like S&Ls, they're just thrifts, and they'd been given a mission: make low-cost fixed-rate loans to individuals mostly, and use your cheap deposits to fund those loans, and be safe. Don't do anything crazy, and that worked. I mean, that's the mission we gave them and the S&Ls and to the banks to a large extent during the Depression, because things got so out of control. We're never in control. Prior to the Depression, the wild 20s, and the whole thing blew up, and we had to fix it, and we had to stabilize it, because people were doing a lot of risky things and dumb things. It wasn't a successful business. I'm not talking about just the thrifts and the banks. We clamped down on everybody. Franklin Roosevelt closed 30,000 banks, shut them down.
Yeah.
And people had to sit there and wait to see what we were going to do. And then they reviewed all 30,000 as quickly as they could, and they opened 20,000 of them and kept 10,000 of them closed. So it's a real crisis. And what they said was, no more of this. You guys are going to behave. I mean, there were different opinions about what to do. The bankers, the big banks, and Roosevelt himself wanted to get rid of the small banks and focus on regional and larger banks, which they thought would be safer, more sound, more diversified, and so forth. The bankers didn't like that at all, and at least the community bankers and the people in Congress mostly didn't like it. So what they did was they said, we're going to start a federal deposit insurance system. All the state insurance systems, there were a lot of them, they all went broke because they didn't have any diversification. So they decided they were going to set up a federal deposit insurance corporation, which would be diversified and it wouldn't fail, not so easily at least. And so that's what they did, and that won the day. And the price of that from Roosevelt and was you've got to be, pardon my dog, but he says the price for that is you're going to have to be tightly regulated. We're going to tell you what you can pay for your deposits. We're going to tell you what you can charge your loan customers. We're going to tell you where you can branch. We're going to tell you who you can hire and who can be on your board and all these things. Okay, and how much capital you need. And that's the deal. You have a safe environment, low risk. We don't want you to take risks. We don't want you to fail. And the price for that is you got to behave according to our rules. And we're going to examine you to make sure you do that. So that's the system they set up. Now we fast forward to the 70s, well, 60s first, and then the 70s. We fight a war in Vietnam without paying for it. President Johnson, President Kennedy gets shot. His brother gets killed, and his brother gets killed. Martin Luther King gets killed. We have riots in the streets, and we have a Great Society program that Johnson comes up with that's hemorrhaging red ink and deficits, along with the Vietnam War. So what happens now? Obviously, interest rates are not going to stay where they are. They're going to have to go up because we've got all this massive borrowing and spending. And so we changed the climate we gave the banks in the thrifts in the 1930s. We broke our deal. And now I'm at the FDIC, and my job is to clean up this mess because we have thousands of banks that are on our problem list. And so we start doing what we have to do, and that is we deregulated as quickly as we could. We let them pay higher interest rates and try to give them more freedoms and flexibility. And we had to come down on them and deal with the ones that were not going to make it.
Yeah.
And the first group were the savings banks. That was our first priority. That's the first thing when I got to the FDIC, first thing I did was organize 2 task forces to look at all the savings banks, who was going to fail and when, and how we were going to handle them. And we had the whole list all laid out because you could do it. It was just math.
Yeah. Well, back then before you joined the FDIC, I've heard that the risk management advice to banks was the 3-6-3 rule, that you pay 3% on your deposits, you lend at 6%, and you get out on the golf course by 3 p.m.
I remember that.
And that rule worked great in the era when there was a little community bank in every city and interest rates were stable. But as you said, that the interest rate part left us after Vietnam and with inflation in the 70s. And then the sleepy little bank in every town kind of left us in the consolidation of the 90s. And so now we have this world where not only are things moving super fast with bank runs where not only can depositors go visit a branch in any city, but they can do it online. And also the rates are shooting up. So it seems like today's environment is like an even faster version to what you experienced in the early 80s.
It's a very similar environment, but the speed with which transactions can occur has picked up a lot. So that's a change. That's something we got to get more comfortable with and more knowledgeable about how to deal with it. And I can tell you that people weren't paying attention to it properly in the past 10 years. I mean, some of the things that we've seen happen shouldn't have happened, not that quickly. And an important part of that is how you control your funding. You can't borrow short term and lend long term.
Yes.
And I thought that First Pennsylvania, which was the largest bank in Pennsylvania in 1979, it failed. Paul Volcker and I dealt with that. And by the way, Paul Volcker came in as chairman of the Fed within a year of when I came into the FDIC. And what a wonderful experience that was for me. A great person, a great citizen, a great patriot, and he did a wonderful job. Unfortunately, after he left office, Congress did it again and got us back into the mess that we worked so hard to get us out of. But in any event, we really got in trouble with the interest rates and the inflation in the 1960s and 70s. And Paul Volcker came in, Carter appointed him and said, fix it. We can't do this. Poor folks that don't have money can't afford this inflation. People who are on pensions, Social Security, they cannot afford these interest rates and this inflation. And so you're going to have to do whatever it takes to kill it. And so that's what Volcker did. And I was ready for that because I could see that even before Volcker got there, that the savings banks were not going to survive with this inflation. We studied every one of them and we put them in an order. Who was going? You could do it. It was math. Who was going to fail first? You give me the interest rate, I'll tell you how long they're going to last.
Yeah.
And so we had 2 or 3 teams of professionals ready to take over these savings banks and handle them in an orderly way, in an order we selected, because we knew then they were going to go broke.
Yeah.
And so that's what we did. And now but believe it or not, that was the easy part, because that was math. We could predict that. What you couldn't predict is the banks, not the commercial banks. When were they going to fail? It depended a lot on what decisions they made. The savings banks didn't have much to make in the way of decisions. They just did what they did, and tried as best they could to get out of harm's way, but mostly they couldn't. But the commercial banks had decisions to make. How they're going to fund themselves? Are they going to fund themselves short or long? Are they going to buy hot money? Are they going to make risky loans or get conservative, stop making loans? What are they going to do? And they had a lot of decisions they could make, and they weren't used to making those decisions because they had always been, since the 30s, highly regulated.
Yep.
You said, what was it, up at 3 and on the golf course by 6 or whatever it was.
Right.
But anyway, up by 6 and on the golf course by 3, and that was a nice life.
Yeah.
But it wasn't going to last, and now they had choices, and they had to make those choices, and the FDIC and the other regulators had to get a lot more involved in regulation. So it was a very, very busy time for bank regulators. We had to change a lot of things. When I got to the FDIC, we had 3,000 employees. We got to 20,000 before it was over. Before it started to wind down, we got to 20,000 employees, and we handled. We had thousands of banks on our problem bank list. We're very busy, and 5,000. 5,000 of them failed. Around that area, and it was a very, very busy, difficult time. We never had a weekend free. Every weekend we handled bank failures, and it's amazing what the FDIC people and the other agencies did for about 8 or 9 years. Just failure, and problem banks and enforcement actions. Busy time. We got through, and altogether, well, the S&Ls didn't. The S&Ls got put away. They were given $150,000 of taxpayer money, and that was loaned to the FDIC, and the FSLIC was put out of business. So the FDIC cleaned up the S&L mess, and with taxpayer money, and then the banks and thrifts had to agree to give it back. The ones that survived had to agree to give it back after it was over, which I think they've done, or they're certainly doing.
One of the things that it seems like came out of that crisis was a lot of new regulation, and also a lot of guidance. That I just was looking this morning at one of the policy statements on how the FDIC handles security interests in receivership. But you have much longer things like the Basel capital regulations, and even more recently you have things like the Volcker rule, named after your friend Paul Volcker, which is dozens of pages long. And if you look in other areas like credit, liquidity, there's a whole laundry list of guidance and expectations that regulators have for how banks are managing these different risks. And all of that is guidance that really you were making up as you resolved this crisis. Like you had to develop these tools to try to help some banks save themselves, and yet all of these tools didn't prevent the recent failures. Do you have any ideas why that was?
Yes, I do. You'd be surprised to learn. I was up in the middle of the night last night working on that. I am very concerned about where we are right now with bank regulation and supervision, and I am going to try my best to see if I can help change it. We have been in this business in the United States for about 250 years. Alexander Hamilton tried to start us in it with the first Bank of the United States, I think it was called. And that lasted for 20 years, and they got rid of it, and then they did another one, the Second Bank of the United States. But anyway, Alexander Hamilton was trying to create a sensible system of organizing, regulating, and controlling banking. He was not able to do it. Particularly in the South, people didn't want it. and it was a new country, and it was not it was we needed a system to run the government, if nothing else, but we didn't really have much of one, and the public didn't much care about it, and so we didn't create a system. But Alexander Hamilton, to his great credit, saw the need and tried to do it, but couldn't. Other people followed and couldn't. Andrew Jackson thought it was a horrible idea,
Yep.
and so we didn't do it. And now we get to the civil, and so a bunch of private banks start, and they're state regulated to the extent they're regulated at all, which was not much. Then we get to the Civil War, and finally we say, hey, we've got to have some kind of a federal system here. And so we created the Comptroller of the Currency in 1863. And so that was the beginning of a somewhat modern financial system, but it was really rudimentary. And we never did put together all the pieces at one time. And we did it piecemeal. Jump to the 1913, and we created the Federal Reserve System. That was the first time we had a central bank, a real central bank, but it didn't altogether know what it was doing. And things got all bollocksed up. We had a major banking crisis in the 1920s. Wild speculation in the 1920s, followed by a major depression in the 1930s. And that's when they said, well, we've got to have something here. All the state insurance funds failed, all of them. And so they said, we got to have an FDIC. So we created an FDIC and a bunch of other things that helps. And we get to the, we don't do much of anything through World War II because we're trying to win a war. And then we get to the 50s, and everybody's really thrilled to be in the 50s. We're at peace, and we get the economy really running. We create automobiles and housing and college educations and all this, and everything's good. And then we forget the important stuff, like having a proper monetary control, having proper fiscal control, and we let the economy get way out of hand. And the public, for that matter, because we had riots in the streets and Vietnam protests and civil rights protests and so forth, and we lose control of the economy. And the banks that we created to be safe and sound and behave, they can't do it in this environment, this inflationary environment. And they can't pay the interest rates that the markets are requiring, and they can't deal with the growth that's happening. And so we wind up in the 80s in a horrible situation, which probably would have been worse. I don't say probably. I think it would have been a lot worse than the Great Depression had we not had the FDIC and the Fed there.
Oh, definitely. Yeah.
And so, and then we fix it. And I don't need to go into all that, but both and the Fed and the FDIC worked night and day for about 10 years or more, and through the weekends and everything. It was unbelievable what they did, and we fixed it. We killed inflation. We got the economy in pretty good shape. Clinton's president. Gingrich is overseeing him so he doesn't get out of hand, and they balance budgets, and they get through the 90s, and we had debt at that point. Our debt was down to 5.6 trillion, 5.6 trillion, and we were even talking about, hey, we may be able to get rid of debt.
I remember that.
Yeah, and so all's well, and all is too good to be true. And we decide we got to fight wars again.
Yes, trillions.
And we attack Iran or whatever we did, and we start fighting wars. We start having big deficits, and we start spending money like drunken sailors. There's no program that's too wild to be approved. And when I was chairman of the FDIC, we really did talk about hundreds of billions. And those were numbers that we used.
Yeah, right.
I don't recall ever using the word trillion when I was chairman of the FDIC. Now, billion seems kind of quaint.
Right.
When I was chairman of the FDIC, million was a sort of quaint, but
Yeah.
but billion was the word,
Mm-hmm.
and now billion is a rounding error at best, and
Right.
we stopped talking about $1 trillion programs, multi-trillion-dollar programs, and
Mm-hmm.
money has no value anymore, and that
Yeah.
means inflation. That means
Mm-hmm.
the Fed is throwing money into the system,
Mm-hmm.
and how does a bank survive in that environment? How does anybody survive in that environment? And so Paul Volcker spent, and he's a hero of mine. I mean, I loved the guy,
Yeah.
and what a patriot. But anyway, he and I and a lot of other people. I'm not trying to take a lot of credit. Worked night and day for 10 years to
Mm-hmm.
kill inflation and get the economy under control, so ordinary people could live
Yeah.
and feed their kids and buy
Mm-hmm.
their houses and go to school. And four presidents in a row, Bush,
Mm-hmm.
Obama, Trump, and Biden have just blown it.
Mm-hmm.
They've thrown money at these problems.
Mm-hmm.
Now, we don't have problems that deserve that kind of money,
Right.
and they just it's wasteful, and
Yeah.
and they've destroyed what it took us 10 years to do, and all the sacrifice. Look at all the farmers
Yeah.
that lost their farms in the 80s. Look at all the energy companies that lost their businesses, the
Mm-hmm.
real estate firms that lost everything, the homeowners who lost their houses.
Yeah.
Uh, and then we had money center banks, well, regional banks all over the country lost their businesses. They went
Yeah.
down. We
Yeah.
had many of the major regional banks went down,
Yeah. No,
and
I remember one of this firm's largest clients was Continental Illinois. Back in the 80s, that was
I'm
one of
sort of
the.
familiar with that one.
Yeah. Yeah.
And well, it's hard to believe that all that happened. And you know what? I'll tell you something else. Let's look at J.P. Morgan Chase, our largest bank today,
Mm-hmm.
and it's composed of the chemical bank.
Mm-hmm.
The chemical bank is the core of it.
Right.
Walter Shipley was running chemical, great banker. He assembled a bunch of this, but it's a combination of Manny Hanny,
Mm-hmm.
Chemical Bank, Chase, Morgan, and I think there's another big New York bank. I'm not blocking on it right now. Those were all part of it. They took all these massive New York banks and combined them because they couldn't make it. They were not being run right.
Mm-hmm.
And then you merge into that first Chicago,
Mm-hmm.
National Bank of Detroit, Bank One,
Mm-hmm.
Texas Commerce.
Yeah. Yeah.
And it's hard to imagine that.
Right.
I mean, when I was chairman of the FDIC, if you told me that was going to happen, I would have said, no way, that'll never be allowed. We never do it.
Right.
But it happened, and it wasn't over. WAMU.
Right. Yep.
And First Republic.
Yeah.
And I could go on the count.
Right.
And so it's just astonishing what we've had to do to fix these problems that all came from wild and crazy monetary and fiscal policy.
Yeah. One thing I think that was interesting that you were talking about that I want to come back to is you were saying when you first got to the FDIC, you were able to put a list together of the savings banks, and you could kind of plot out what order they would fail in based on their financials. That is just a function of interest rates.
Right.
And I think today a lot of people are concerned that there are many regional banks who have these large portfolios of either mortgage loans they made or mortgage-backed securities they bought or treasuries that they bought to help fund the deficit. And all of them have a pretty low interest rate that over the last 10 years. and they are a long-term asset that maybe has a 15, 30-year lifespan. And opposite that, you have deposits that people, if you don't pay higher interest, they're going to leave. And so you kind of, as you were saying, you're borrowing short to lend long, and the interest rates are shifting against you. Um, that sounds like you could plot out a similar course looking at those differentials, the net interest margin, and see banks that are going to be coming under more pressure now. Do you have similar solvency concerns now?
Sure. That's what we just watched happen.
Yeah.
But it shouldn't have surprised anybody, because in 1979, I think I mentioned earlier, First Pennsylvania, the largest bank in Pennsylvania and the oldest national bank in the United States, it did exactly what you're describing. They made a bet that the Fed was not going to raise interest rates in 1979. Strange bet to make, but they did, and so they were borrowing short and lending long, and they had a terrible mismatch, and they went broke. That was one of the first major banks we had to handle when Paul Volcker came in. That was one of the first ones on our list, and so we put it out of business. And you would think that every banker and every bank regulator would know from that day forward, don't do that. That's not a good thing to do.
Right.
Borrow short and lend long. Don't do it. And if you do have to do it, hedge it.
Right.
And we developed all these hedges and things over the years to help banks take care of those problems. And then we get into this period. The Fed starts doing its crazy stuff on interest rates. What do they call that? Quantitative easing and all this stuff. Yeah. And they push interest rates down to zero or near zero, and they keep them there for 10 years.
Yeah, it was great for the time.
Well, I don't know why I don't know who thought they were great, but I didn't. Yeah. And I mean, if you were borrowing money, I guess it was great, but it wasn't such a good deal for the person on the other side of that transaction.
No.
And the Fed should never do that kind of thing. And they've got to play in the real world and understand human nature and all that. But anyway, they did it, and these banks started following the lead, and they could have done that, but they had to do it reasonably. You can't borrow 60% of your money, hot money, long-term hot money you're borrowing. I think that they just really let it get away from them. They weren't thinking, but I understand it, because the whole world wasn't thinking. Everywhere, rates were like that all over the world, and the central banks of the world, including the central bank of the United States, was endorsing that in effect and encouraging it. I don't understand that. I don't understand how they did that. And then the regulators inexplicably fall asleep.
Right.
What was the San Francisco Fed doing?
Good question.
Loaning that kind of money, or allowing those banks to do what they were doing.
Yeah.
You couldn't miss the interest rate mismatch. You knew it was there. And one of those banks, I can't remember which one, but actually I can, but I'm not going to say. One of those banks, actually both of them, I think, grew. They tripled.
Yeah.
They tripled in 2 years in size.
Yeah.
They went from, I think it was, I don't remember the numbers. I think it was 70 billion to 150 billion to 220. I'm saying billion. That shows how old I am. Trillion.
Billion is real money. It is real money.
And so go from $70 billion to 220 billion, say.
Yeah.
In 2 years. Who would have done that? Who would have thought that was a great plan? But it's not so much the bankers.
Right.
They maybe just forgot what they were doing or didn't understand it. But the regulators didn't do anything to stop it.
Yeah. I think about how like the FDIC, I heard that the DIF has a balance of something like 120 billion total in the DIF. And I mean, yes, they have the full faith and credit of the US government, so we don't really need to worry. But when you talk about a bank being almost twice the size of the DIF, I would want to be looking at that pretty closely to make sure that they're not going to wipe out my whole insurance fund.
I would applaud you. and, and it's interesting because you say that the FDIC has, or the Deposit Insurance Fund has access to the full faith and credit of the United States, and it does, thanks to the period when I was chairman, because we felt we needed it, and so we did go for it, and but we tried not to use it ever, and we didn't want to use it. I think they did after I left for a short period, but it didn't last very long, and I didn't use very much, and it was all paid back. But I think that what we are forgetting today, a lot of people, well, not so much anymore. I think we've got everybody's attention today, and that is that the U.S. government is writing a lot of big checks, and it's overdrawing its accounts big time.
Yeah.
We have borrowed $32 trillion, up from 5.6 trillion just 20 years ago.
Yeah.
5.6 trillion to 32 trillion. Moreover, the Fed, when Volcker was chairman of the Fed never had borrowings on its balance sheet. And I think the high point was 800 billion. And I kept on asking Paul. I said, "Can't you borrow some money? Because we're running a little short here." He said, "No, I can't and won't." He said, "If we need more money, we're going to have to go to the Congress and ask for appropriations." And we don't want to do that. But we're not going to do the other. We're not going to we're not going to destroy our balance sheet.
Right.
And because where would the world be without the Fed having a balance sheet? And so in any event, we didn't do that. But the 800 billion from Paul Volcker's day now stands at around 9 trillion. So we add 32 trillion in federal debt, plus 9 trillion in Fed debt, and we're up at my math says that's 41 trillion. Yeah, and that is unheard of. They used to call the Greeks and the Spanish and all these people the pigs. Yeah. Portugal, Italy, Spain, and whatever, Greece. Yeah. They were called the pigs because they had their borrowing on their balance sheets at the government level exceeded 100% of their GDP. Right. We are the biggest pig of all now.
Oh yeah, over 100%, clearly.
Well over 100%. Yeah. And it can't continue. I'm so happy that they finally paid some attention to the deficit and the growing fiscal irresponsibility in the Congress yesterday and this recently, and hopefully they'll get it, at least take some baby steps and get it stopped. And then we just got to keep on coming back and back and back and beating those numbers down. We can't live that way. We can't. I feel very strongly about it. I'm trying to do everything I can possibly do to be helpful. And I do think that I think we're probably running out of time here. We've been talking at some length, but there is one other point I want to make, and that is I think that our regulatory system is not doing well. It has been grown piecemeal, haphazardly, by accident, by political compromise. People have done all sorts of things that don't make sense, that are not getting the job done. we've been careening from crisis to crisis to crisis now for about 90 years. From the Great Depression, we've had about 5 major upheavals from in the past 90 years, and they're coming more frequently and they're costing more money. And we can't keep that up. We've got to turn that around and stop it, which means we have to fix the regulatory system, and that is going to be one of my major objectives. As long as I have breath in my body, I'm gonna be looking at that, working on that, and trying to get us to come up with a much better, less complicated, less convoluted, less haphazard, more intentional, more safe and cautious regulatory system. I don't mean we're going to shut everything down. I'm saying we're going to do it right. And we have a regulatory system right in place that is a mess, and it needs to be fixed. And there's no excuse for us not to fix it. And I don't think politicians have to do it because they have to pass the laws, but I don't think they can lead it. I think bankers are going to have to lead it, and bankers, and because they know what needs to be done. Bankers know what needs to be done. And I think the regulators know what needs to be done. They don't necessarily have the courage to do it, but we really do need to fix this system. It's broken, and it couldn't be more clear.
I look forward to seeing your solutions, and I'm certainly rooting for you as a longtime member of the banking bar myself. I am rooting for you to succeed with these plans. And Bill, I really just want to thank you for participating in this episode of Credibly Challenged. It was great to get your 54 years of experience with the banking industry, and I'm glad you did not become a labor lawyer. That kind of common sense banking wisdom is just invaluable. I also want to thank our audience for tuning in. Without you, we wouldn't have a reason to do these programs, and so please stay tuned for the next episode. Thank you.
Thank you, Matthew.